Steve Leisman. Let me bring in my next guest, Chris Crisanti and Jim Bianco, to respond to this as we see negative stock market sentiment as well has been surging of late. Chris is chief equity strategist at MAI Capital Management. Jim is president of Bianco Research, and welcome to you both. Quick reaction, Jim. How important is the next Fed rate hike or 2 or 3 or cut to do you prefer stocks or bonds here at this juncture?
Well, the next rate hike is going to be really determined by what is the fallout of this banking crisis. Are we going to continue to see some kind of a credit contraction because banks cannot trust their deposit base? I happen to be in that camp, that the deposit base is now unsure for the banks. They're not going to be as willing to hand out loans, and that's going to lead to a broader and faster slowdown in the economy. If so, then the Fed's not going to hike rates. If I'm wrong on that, then we've overstimulated the economy, and they're going to hike rates aggressively. They're going to go right back to where they were at the beginning of March and be looking for 6% or more. So expect extreme volatility in the bond market, which is what we've had. Given all of that, I think that the thing that is most at risk is risk markets like credit and like stocks, and that they are going to be really struggling in this environment, even though they haven't been for the last few weeks. I think as we go forward, it's going to be a bigger struggle for them.
So you would rather, if I gave you the choice, you can own the NASDAQ, or you can own the 2-year. What would you pick?
Well, let's see. The 2-year has had its worst year ever, and it's still outperformed the NASDAQ over the last 18 months. And now that the 2-year is giving me over a 4% yield, I would probably pick that going forward from here, because I'm not sure that the economy is ready to turn around if we're facing a credit crunch.
Chris, which side would you be on?
Kelly, it's good to be with you again. I think the problem with taking the bond side here is it's become the consensus bet. So, the 2-year had, although Jim is right, it's obviously rates have come way up over the last 18 months. In the last month, the 2 years had its best period probably since the 1987 market crash. The 10-year has dropped 70 basis points in the last month. So this is not a contrarian idea. This is one that the train has left the station. Everybody's on board. I think actually stocks are the contrarian idea right now. And for that reason, there's some bargains to be had in the market.
Do you remain, if I'm not mistaken, somewhat bearish about where the overall economy is headed? And I know you were saying just recently that you are excited about bonds for the first time, but did we just kind of pull forward a year or two of returns into a 1-month period of time?
I think to really get on the bond train at this point, you'd have to believe that Jay Powell is going to lower rates rather quickly over the course of 2023. And I just don't see that. I think the market is anticipating that. And if he said anything, he's been straight with us in saying, higher for longer. Now, we may have a pause, but that's a lot different than rates going down to support an even lower 10-year than we've seen over the last month, again, as it's dropped 70 basis points. And so I think Jim and I are relatively pessimistic looking forward on the economy. But I think the difference we might have is I think a lot of that is in stock prices, at least certain stock prices already.
All right. Have to leave it there. Can we do it again? Would that be all right, gentlemen? Thank you very much for your time today, Chris Crisanti and Jim Bianco. That does it for The Exchange. Tyler's already getting ready for Power Lunch after